There you go. Okay. The panel's being moderated by Lorenzo Marinucci, who I think you all know. Lorenzo's co-chair of the Morrison Foster Business Restructuring and Insolvency Group. He represents debtors, creditors, and creditors committees in complex cases. But I think most of us know Lorenzo as one of the leading players in representing creditors and creditors committees in major cases around the country. So I'll just turn it over to Lorenzo.
Thank you. Thanks, everybody. Can you hear me okay? Okay, great. So I'm just the moderator. I don't really count here. I'm just going to throw a couple of questions at them and let them go at it. But my job is to introduce the panelists. And let me start. To my left is Kathleen Lauster. Kathleen is a managing director at DLA LLC and heads their capital advisory and restructuring practice. Kathleen has over 20 years of global financial services and commercial real estate experience working for and advising firms in Europe and the U.S. with their capital raises, with their restructurings, asset management, and with respect to valuation. Prior to joining DLA, Kathleen served as a managing director of restructuring and corporate finance at Silverleaf Partners LLC and was a senior vice president with Houlihan Lokey's financial restructuring and real estate strategic advisory practice. Next to Kathleen is Jeff Altman. Jeff is a managing director with Jefferies Real Estate, Gaming, and Lodging Group, which we use the acronym REGAL, and I learned that too for the first time. And Jeff has over 21 years experience in investment banking, specializing in M&A, restructuring, public and private capital raising, and other strategic advisory services. Jeff has advised on over $75 billion of transactions. Prior to joining Jefferies, Jeff was a managing director in the Regal Group at Houlihan Lokey and a director in Lazard's Regal Group. Jeff's experience includes multiple real estate asset classes, multifamily office, retail, net lease, but Jeff's primary focus is hospitality. Jeff's notable recent lodging assignments include Hospitality Investors Trust, Red Lion Hotels, and the merger of Benchmark and Pyramid Hotels. Next to Jeff is Robert White. Rob is a managing director with Jefferies Debt Advisory and Restructuring Group. Rob has been with Jefferies for over 12 years and has 22 years of investment banking and distressed investment experience. Before joining Jefferies, Rob was a director on Barclays' distressed debt trading desk, and his recent hospitality and real estate related restructuring experiences include Hospitality Investors Trust, JCPenney, and Extended Stay Hotels. Last but not least is Mark Podgany, who's a managing director at Getzler Henrich & Associates. Mark has more than 20 years of experience in operational roles and turnaround consulting. Mark has extensive experience in the food and hospitality industries, including line and management positions, and significant consulting experience in the real estate supply chain, where he has advised hospitality, residential, and multifamily real estate companies in workout situations with their lenders, and he has also served as a chief restructuring officer in special situations. So with that, here's my first question. COVID has had quite an impact on a number of industries, but at least from my perspective, it seems to have had a tremendous impact on leisure and hospitality. Why do you think that is? Jeff?
Sure. I mean, look, pretty simply, in my spaces, as Lorenzo mentioned, I cover both real estate and traditional real estate and lodging. Traditional real estate has leases, and so while there were some threats of tenants not paying during the pandemic, actually most particularly larger, higher quality tenants did pay. Those that could afford to, those who could not. I think in many cases there was a pretty good dynamic between landlords and tenants. But in the hotel space, pretty quickly, most forms of hospitality went quiet. Many owners had to figure out how to dramatically cut their costs, and so I think it's really just a function of the nightly rate function of hospitality compared to more traditional forms of real estate that had protections from leases and other things that at least helped to mitigate some of the losses that hotel owners felt.
And on a macro level, COVID affected lots of industries, but in particular when you deal with hospitality and leisure travel, when you're in a situation where cruises aren't running, conferences are getting canceled, laws are put in place that prevent gatherings of more than X amount of people, that has to have an impact on the hospitality and leisure market. It's got to be more significant.
Yeah, I mean, if you think about it, a lot of hotels shut down for 3 months. No incoming revenue. And there are still hotels that are shut down. So there was no travel. People were isolated in their homes, and there was just no revenue. And when you have a fall off in revenue, 2019 was one of the best years, if not the best year in the history of the hospitality industry, to zero. It's going to hurt pretty bad.
Do you think we're going to experience more or less distress in 2022 in the hospitality industry?
I think it's going to be more of the case of the distress bubbling up. So distress hasn't bubbled up because there's been a lot of PPP funds and the ability to use FF&E reserves and interest reserves. And there's been a lot of forbearance. So there's been a lot of reason for distress not to bubble up. But next year, a lot of the flags will, or probably all the flags will require contributions to FF&E reserves and resumption of capital expenditures to support property improvement plans, PIPs. And standards that were relaxed in the last year and a half will be reinstated. Foreclosures that never happened because the courts were closed the courts are kind of, the log jams are going away. So there's a lot of things, a lot of dynamics now that should allow for some distress to bubble up in 22, at least from what I see.
I think it's also worth pointing out that the liquidations is a bit of a lagging indicator. So if we look at the last recession, liquidations did not peak until 2012, which was well after the economy had began to rebound.
I would just add, I'm the restructuring guy in the group and a generalist. To me, when it comes to the hotel industry, it's pretty simple. It comes down to occupancy and what you charge on an average daily rate. And obviously, during the pandemic, hotels were shut down for a period of time. There were travel restrictions, so you had significantly less business travel. But a lot of that, is behind us. You're seeing occupancy rates that are pretty close to 2019 levels. You're also seeing operators being able to improve their average daily rates. Many of them near 2019 levels. Also, during the pandemic, and Mark, you touched on this, what we saw was there was tremendous flexibility from lenders. They were willing to give operators relief when it comes to covenants, PIP reserves, FF&E reserves. That created some liquidity runway that bought these operators some time. So for us in the restructuring group, when we're tracking opportunities in the hospitality space, frankly, we don't really see any in the near term, in the traditional sense. We don't see defaults coming. There's been all of this relief, and demand has snapped back. There's still some challenges. There's significant challenges on the labor side due to labor constraints and willingness, frankly, of people in the hospitality sector to go back to work. Whether I think there may be opportunities for investing in situations like this are in those companies that they've begun to see that recovery, as I've talked about, but they may be hitting an inflection point. They may have still remain over-levered. Their liquidity may be constrained. There may be opportunities to, in effect, repair balance sheets and put some new money to work. I think investors may have the opportunity to put new money to work at relatively attractive valuations to help delever balance sheets and continue to let these companies grow back to normalized levels.
You made a good point about the industry snapping back, and it has snapped back significantly. The recovery's been pretty uneven. Limited service hotels, for example, have done very well. They're probably exceeding 2019 levels now. But downtown hotels like here in New York are suffering because of the lack of the business traveler, the transient business traveler, and group travel coming back. So there has been a recovery, and it will continue to recover, but a lot of hotels still can't pay their debt service, to Robert's point. So, recovery is great, but if you can't pay your debt service, it's not good enough. So until we snap back a little bit more, you're going to see some fatigue from the lenders, and you're going to see some things happen in 22, more so than in 21, but no avalanche from what I see.
And I just add, one of the additional challenges is, has there been a permanent shift in business travel, right? We're all constantly on Zoom now. I mean, I'm seeing it within our own investment banking group. Our industry coverage officers are traveling less, despite the fact that people are back in the office. For certain meetings, Zoom may be good enough.
Yeah, I think about 6 months ago, Bill Gates came out and made a somewhat of a self-interested proclamation, given he owns Teams and other things that benefit from this, although he also owns a lot of hotels, but came out and thought that business travel would be cut in half permanently. I think that's probably not the right number, but I have heard people floating numbers like 20%, and no one really knows. I mean, I think certain parts of business, someone who's very sales oriented, or I can only speak for myself, being in front of people. Now look, I spend a lot of my time in the hospitality space, so my clients really appreciate, more than others may, sort of showing up and being there in person. So I think there's certain jobs that people really get a lot of bang for showing up today. That being said, it does feel like there may be some permanence to this idea of people traveling less, but I will see. Time will tell. In some ways, a lot of what we're seeing, kind of to me feels like the dot-com bubble, where particularly on the employment side, everyone was getting whatever they wanted until there was a snap in market valuations, and that may come again. But we shall see. I'm personally not a believer that people like to socialize. They like to be in front of their friends and others, and we can see that today in the hotel business. The leisure spaces has been on fire, and you're seeing assets trade at 25 to 50% premium for luxury assets that over where they may have traded in 2019. So to echo a lot of the comments on this panel, I do think lenders, Kathleen made the comment last time, was sort of at the back end when you saw the most delinquencies. I mean, I can't remember a capital market environment stronger than right now, both in terms of debt and equity. I mean, Mark, to your point, the major cities are coming back a little more slowly, but the capital markets are pricing that in and way out in front of it. And so I think lenders are really getting fatigued, for a myriad of reasons, but in particular, they're seeing a lot of new money wanting to be invested either in existing cap structures or just buying assets outright. And, if you're a borrower, I think the day of reckoning is going to come pretty quickly this time, because lenders can afford to, pursue actions or sell their debt or do whatever they may do. But I think those situations are going to be isolated, because where there's any equity value above the debt, the market's really aggressive right now in terms of pricing the recovery trade. At least in the, I'm a little more public market focused, and but I would say I've seen that at the asset level, and I think people have long memories, and those who waited out of the financial crisis and or those who were able to make investments early on really benefited. And so we're seeing a wall of capital that was raised for opportunities that didn't materialize, and that capital in many cases wants to be put to work. And I haven't seen a more aggressive equity market, despite even the most recent. We'll see what happens with the most recent variant, but the capital markets to me are wide open, and we're seeing lenders do pretty aggressive things, particularly for new money deals that substantiate value.
Go ahead.
So it's interesting, though, on the bank loan originations, it's worth noting that they are off 80%, 2019 levels. And I agree, Jeff, there is a lot of capital out there, but it's all in the alternative lending and the equity side. And so there are going to be borrowers out there who are in need of refinancing or seeking new debt, and they're going to be having to tap into the alternative universe because they're not going to be able to keep up with the LTV and higher debt service coverage ratios that the banks are requiring these days.
And maybe you guys can comment on this. The other thing that I've noticed is, this is on the positive side, occupancy rates are increasing, ADRs improving, nearly close to 2019 levels. But you've got a situation right now, at least as I understand it, where there's not a lot of new construction. And there was new supply of hotel properties and rooms coming online, which I think would be a near-term catalyst from a performance.
Why is that? Is that because there isn't, I just heard there's a lot of capital, so there must be capital to put up the hotels. Is it a supply chain issue? What's the issue there?
I think it's a couple issues. One, there are inflationary pressures, construction costs are significant. But heading into the pandemic, there was, I think, a pause in new construction and a slowdown in new supply of rooms. And that, I think, as a result of the pandemic, people paused further and delayed new investment.
Yeah, look, I think to address your comment, I mean, most of the capital, while there is a wall of capital, it's more, I wouldn't say distressed oriented, but it's capital looking for attractive attachment points, and so that capital is probably less well suited for development. Plus, I think there is a view, because of the supply chain challenges, inflation's on, feels like it's here and it's going to stay. When you add up all those things, I mean, one of the things historically that's made real estate and hospitality an attractive investment classes is sort of inflation's been good for that. And so I think one of the reasons people are sort of buying rather than building is they feel like they're getting it at a good attachment point relative to what a replacement cost is. And in some ways, that's sort of driving pricing as much or more than multiples.
You mentioned inflation. What impact do you think inflation will have on hotel performance?
So it's kind of a mixed bag, right? Because as Jeff mentioned, historically, inflation has been very good for the hotel market because you can increase your room rates daily to reflect the changes in the prices. On the flip side, however, it does put a lot more pressure on bottom line margins. And while it's true that RevPAR may be back to 2019 levels as soon as next year, if not the end of this year, the challenge is that if you put it on an adjusted for inflation basis, we're still looking out perhaps 3 to 4 years till we get back to 2019 levels.
Sounds like a challenge in forecasting too.
Yeah, absolutely.
Well, one of the comments that Robert was making about supply does have an impact on forecasting. For example, just in the downtown market here, you don't know whether certain hotels will be taken out of the supply to be converted into apartments. That's a big thing that people are talking about. I don't know how much of that is actually happening, but it's definitely being talked about, and not only here, but all over the country. So the question of, is my competitor going to be around next year? Because if they're not, that would be great for me. And whether new construction is going to be slowed impacts the supply picture and what I can do with my rate and how I can market my product. So the supply is definitely impacting the forecasting for next year. And I think some of the other points that came up, business travel. There's a new variant, right? The Omicron variant. I mean, are people now canceling their conferences and because of the Omicron variant? We're going to have a whole series of variants, and this thing may never be over. So, but it's a psychological impact on the traveler and whether people decide to cancel bookings or not travel. So the uncertainty from the hotel standpoint is immense. Just when you thought the thing was licked, and it comes back with the Omicron variant. So it's one of many forecasting conundrums that people are facing, along with things like labor, right? no one in this room is finding it easy to hire people, right? Can you imagine the club here or any of the hotels? People have had epiphanies during COVID, changed their careers, moved out of the hospitality industry and decided to do something else. And people are demanding more money to do, to clean rooms, to serve customers, to work the front desk. So it's trying to find labor so you can actually host the guest is a challenge and will impact the potential to perform next year.
Yeah, I think it's really interesting, especially the luxury sector. The hotels this year have gotten away with providing less services and used COVID as the excuse, but how much longer are they going to be able to do that? Unfortunately, they cannot provide the level of services they were previously providing because they can't find the employees. So how is that going to work out? And are they going to be able to continue to command the types of rates in a room if they can't provide the same level of services?
I experienced that at a practical level about 2 weeks ago. I was visiting my son at school, and we were staying in a select service like Hilton Garden Inn. Massive sign, huge banner, hiring now on the front of this place. It's very real. A lot of these hotels are suffering from this, but as an example, and I think they blamed sort of still the COVID overhang as this issue. But they basically put a notice up that said, we're only going to be servicing your room every 3 days.
You see that in luxury hotels too.
The COVID thing was all baloney. It was all about the fact we just didn't have it.
I've recently seen
But
that.
you're seeing that in luxury hotels too, and there's a push by the industry to make that standard for environmental reasons, but it's all
Because they don't
profit.
have staff.
Yeah, but look, the changing of the sheets is a real cost. The cleaning of it, right?
The replacement of the sheets too
That too.
costs money. By the way, we have some presentations that are going to be available on the website. I couldn't make them interesting enough for us to sit through them in this room with lots of little charts and numbers, but they'll be on the website. You should take a look at it. It's got a lot of interesting information that was put together by the panelists. So I just wanted to say that before I forgot to say it. Now, we can't forecast. We don't know what hotel occupancy is going to be. We don't know what hotels are going to be built. We don't know if we're going to get a labor shortage. We don't understand inflation or any new variant. So if you're a distressed investor looking for an opportunity to invest in this space in 2022, is there any place to put your money, or is this something that they should just avoid? I'm not making any investments, so there's no pressure.
There's always opportunity, right? It's just it's harder to find, and the hospitality industry is really in a lot of minds is out of favor, and out of favor industries there's value. The problem is that everybody wants a really deep discount, right, to make sure you're going to make money, and there hasn't been a willingness to sell at that price. There hasn't been a clearing price really in a lot of situations. You may start to see that more next year, just because there will need to be assets coming on the market because of the relationship between the borrower and the lender, and the courts clearing and the other things we talked about. But it's been hard to find the value because no one's been willing to sell, or a few. But that should start to change. And if I were an investor in this space, I would definitely be keeping my eyes open and ears open for opportunity, because there should be some better values coming up in the next year.
Look, I think you're already seeing that. I mean, to Kathleen's point, while originations were down 80% probably through the first 3 quarters, my guess is this fourth quarter is going to be, at or close to some previous peaks in terms of just absolute product. Clearly, there's some people, I think, who still believe there'll be some tax reform, and so you're seeing some motivated sales for that. But again, there's a lot of capital out there chasing deals, and I think there's been up to recently, most of the larger transactions that we saw during the pandemic were structured recaps, and that's probably been the one difference. And to Mark's point, there's there've been very few just straight auctions, and in most cases, equity investors, where they can, have preferred to bring in, whether it's preferred equity or some other layered capital that gives them more equity upside or retention of equity upside, in some cases meaningful control and governance versus, selling today, even though the markets have recovered. I think most investors have preferred to bring in, even where it's expensive, Pac-Man like bring in preferred capital rather than sell out. But that's starting to change. I mean, we've seen most recently CorePoint change, just announce a sell-side M&A deal, which was about $1 billion. There's a few large billion-dollar portfolios on the market. Obviously, we saw Eagle change hands last year, predominantly led by Monarch. So, it's coming, and I think it's here now. I mean, I think the statistics for the fourth quarter will be a dramatic turnaround over what we saw the first 3 quarters, because there were virtually no sales other than just absolute distress, and no one tracks in the same way sort of these structured deals. But, if you speak to the real estate brokers today, this is probably the busiest they've ever been, and the debt markets are actually backed up just from a logistical standpoint of not being able to process all the deals that are in the market today.
Yeah, I agree. I don't think we're going to have the deluge of distress that perhaps we all thought we would see last year. But there's no question that next year there'll be more opportunities and investments and special situations, if not outright pure distress. On the bank side, one of the things, and this is not just in the hospitality space, it's really across the board, the commercial banks don't have special servicing groups any longer, or sorry, not special workout groups, and so they are just selling loans. Right now, like Mark said, the bid ask is too wide for them to consider selling these loans. It's starting to change. They do not want to hold these assets, so there'll be some opportunities there with bank loans. On the CMBS side, the special servicers are really dictated by the pooling and servicing agreement, and they have to work through those loans. Those just take it takes some time to go through the courts and to go through the methodology of working them out, but we'll see a lot more opportunities on that side as well next year.
I would only add, and I don't want to be the Debbie Downer at a distress conference, but based on stuff that we've been tracking in the larger cap stacks and the publicly traded hotel REITs, I just don't see any opportunity there. They're again performing near 2019 levels. As I think I mentioned earlier, there may be opportunities for those companies that may be reaching that inflection point from a capital need standpoint and could delever a little bit. There may be opportunity to put some capital in junior, put some new money to work through a structured deal to help delever a balance sheet. But I don't see any traditional distressed investing in the near term in the bigger situations.
So very few bankruptcies. We've seen a couple of single hotel property bankruptcies. They pop up on my feed. But there have been very few large-scale hotel chain bankruptcies. One of the ones that filed this year that we had the luxury of working on, and I worked with Jeff and Rob on it, was Hospitality Investors Trust. Rob, why don't you tell us a little bit about that? Because I think there's a lot to be said about how that started and where it ended.
Yeah, I think there are a couple interesting things about this from how these types of companies get restructured and worked out. Jeff really led this. I led it from the restructuring side. A little bit of background. So Hospitality Investors Trust was a non-traded hotel REIT focused on the select service, mid-scale and upscale market. When we first got involved, it was in the depths of the pandemic. It was spring of 2020. The company at the time had about 140 hotels. There was $1.3 billion of property-level debt in a series of 3 tranches, mostly CMBS and a term loan. Below that, there was over $400 million in preferred stock. This was a new money investment done only a couple of years earlier. HIT historically had been an underperformer, probably over-levered since its inception. But during the pandemic, when we got involved, we were able to very, very early on get some relief from lenders at the property level, again, around covenants, around debt yield test, around deferring the reserves for PIPs.
Use of reserves.
Yes.
Even change the
Yes, so they were showing lots of flexibility. That created some liquidity runway. I think some of the key issues for the company, from the company's perspective, was they had, at the time we got involved, they had received some modest relief. There was some liquidity runway for a period of time. There were hundreds of shareholders in this company, but it did not trade publicly. The stock was completely illiquid. And I think there was a point of view, certainly from certain members of the board, that the COVID situation was an exogenous event, and that over time, the business would recover back to 2019 levels. And this was all just temporary. During the early months post getting relief from the lenders, there was an expression, at least of interest, by the large preferred stockholder of a willingness to put new capital into the business. But they would only do it through execution of a delevering of the balance sheet, where they would exchange their preferred for 100% ownership of the company, and they wanted to execute it through a bankruptcy. So, we were presented with, I think, an interesting dilemma, right? There was a view at the board level that this was temporary and that eventually there'd be a recovery, and there should be value ultimately to the equity. We grappled with these issues, and let me just pause for a second before I get into how we address them. Jeff or even Lorenzo, do you want to add anything?
I think what you raise is something that I think one of the earlier panels today talked about in looking at CBL and looking at Washington Prime. You're at a point in time where you have to assess what the value of a company is, and if you represent a board, and in this case we did, you've got a duty to your shareholders, and your shareholders 6 months ago were in the money just based on how the hotel chain was performing and where the value was. Fast forward, you're running into a liquidity wall, and you've got a valuation that you're staring at, and you have these forecasting problems we just talked about. And so you're stuck with trying to figure out how to balance the desire to provide a recovery to equity, your fiduciary duties to equity, yet still face the reality that you don't have a lot of options to come in and refinance. No one's going to write you a big check to get rid of your preferred debt that's coming due. And so that was the struggle in HIT and how we dealt with it. Rob will talk about.
Yeah. So despite having $1.3 billion of property level debt, the company was generating enough cash flow to be able to service that debt. That debt was, while they were significantly levered, it was a 2 and 3% coupon, so they could service the property level debt. And they were at a point, given the relief that they had received, they were cash trapped on most of the CMBS more than halfway through 2020. So liquidity remained tight, but they were bumping along. The preferred stock, though, was a huge issue. It was a large double-digit coupon. It needed to be addressed. And again, the preferred stockholder was one that put capital in, but only in the context of a bankruptcy. A couple key things that we did in this situation. The preferred stockholder had 2 seats on the board and was chairman of the board. What was key from a governance standpoint is we created an independent subcommittee of the board, and they were tasked with negotiating at arm's length with the preferred stockholder. We also reviewed strategic alternatives beyond what was being offered by the preferred stockholder. The reality, though, was at the property level, substantially all the assets were leaned up. The preferred stock was a highly structured deal. It had a lot of protections that made it difficult to layer them with new capital, and arguably at that point in time, the fulcrum security was the preferred. I will say our independent committee of board members, they negotiated very hard with the preferred stockholder, and we were at this for months.
I think it was probably, from when we really started in earnest, it was from start to finish a good year.
Yeah.
I mean,
Yes.
almost 13 months. On an impressive note, I mean, probably one of the shortest bankruptcies I've witnessed.
Yes.
One of the most seamless, 4 weeks total, something like that.
Yeah, and I think there was a point of view certainly from the independent committee members that, they were going to hold out as long as possible because the company was beginning to show signs of recovery. And if you could hold out just long enough, you know, I think there was a point of view here that, you know, ultimately the equity would be in the money. But like a lot of these situations, you know, it's not always simply about value. It is about liquidity, right? You know, it's about meeting your obligations as they come due. And by the first quarter of 2021, this year, despite showing improvements in occupancy and RevPAR, et cetera, the company was going to hit a liquidity wall. And as part of our negotiations with the preferred stockholder, a lot of it was around getting value to shareholders. And so what we negotiated was a two-tiered CVR structure. And those contingent value rights were struck at a level that would give the preferred stockholder an evaluation, ultimately where that preferred stockholder would get a par recovery. And the second tranche was at a level where they would get a 15% type return on their capital. Like any restructuring, we did and this was all executed through a prepackaged bankruptcy. We did a formal valuation in support of the plan. We did a DCF, we did compcos, we did precedent transactions. And our conclusion was the equity was out of the money on an absolute priority basis, right? But we knew there would be potential risk once we went in of an equity committee forming. I think the other key thing that we did as part of all this is we went out and solicited on a pre-petition basis competing DIP financing proposals to compete with that preferred stockholders proposal. But we asked people interested in doing the DIP to also couple their proposals with competing proposed plans of reorganization. And what we discovered after going to 18 or 20 particular parties, that we got a ton of feedback and viewpoints on value, but we got one proposal. And that proposal significantly impaired the preferred stockholder and put the shareholders out of the money. And I think that gave the board a good amount of comfort that what we had negotiated with the preferred stockholder was ultimately a good deal. And we got the board's approval, and we executed that pre-pack in less than 30 days.
It went quickly, and I think all of the things that Rob just spoke to are things that any competent board is going to do in that situation.
If I could make one comment, Rob, you said something that I think is very true, the whole industry. You said there's been improvements to performance at the property level, right? And, maybe profitable, but not able to meet debt service and potentially hitting you were able to meet debt service in this case, but potentially hitting a liquidity wall. But that's a parallel for what we're seeing. I have a client that's in that exact situation. If I can just hold on long enough, I'm making money. I should be able to meet my debt service soon. If I can just hang on long enough, that liquidity lasts a little bit longer, I can make it. And I don't know if they're going to make it, but that's what this industry is experiencing. And next year, you're going to see that shakeout of people who can't hang on any longer.
I think that's right. I think a part of what we wrestled with in HIT was this notion that someone is taking advantage of a company during a pandemic. And the courts aren't going to allow that to happen. And so if we actually wound up in front of a bankruptcy judge, the judge would see right through this and they'd give the equity something. And I was on a panel earlier this year, the ABI Views from the Bench panel, with a number of bankruptcy judges, and we covered valuation. And so the question for the judges was, when you're in a situation like this, where everybody agrees that this company was worth a lot more a year ago, it'll be worth a lot more next year, but we're in a bind where we just don't have the money we need to actually survive. What does the court do in a situation like that when you try to put on a valuation case and say, Judge, ignore where we are, ignore what we're worth today, think about what we're going to be worth in 5 or 6 years from now, and cut the value that way? And the response was pretty quick and pretty uniform. There are only a couple of accepted ways of valuing a company. We're not going to go ahead and listen to testimony from somebody that's creating a new theory that it was created because of COVID and what they consider to be temporary effects. And so if it doesn't fit into the neat buckets of valuation methodologies, we're just going to discount it, which is a good thing to know when you're representing a board and they want to be creative like that, to tell them that's not what the bankruptcy law allows you to do.
So it's interesting to your, Lorenzo, you were saying, there's the headline risk that a lot of lenders did not want to take, the idea of taking advantage of hitting a borrower in the middle of a pandemic. And, I've been in the distress space now for 20 some odd years, and I have never seen loan regulators as accommodative as they were this past year for that reason. It was totally different in the financial crisis because there was an idea of blame and over leverage and mismanagement, et cetera. But lenders, by and large, in the last year and a half, didn't want to be the bad guys that are hitting a company when they're down, especially in the hospitality space. So they've been kicking the can, doing amends and extends. Some hotel operators will actually benefit from that and will see a recovery, and then there's others that are going to have to be dealt with.
So are you seeing any similar issues comparing HIT to other situations?
Well, I immediately thought Washington Prime. I mean, it's outside the hospitality
Right.
sector, but very, very similar situation. In that situation, you had SVP, probably would have seen this, backstop rights offering. It's the largest bondholder agreed to delever. Not having been involved, but I assume the board fought hard to try to give value to shareholders because of arguably there would be a swift recovery, relatively swift, and there should be value to shareholders. I think the difference there between what we experienced in HIT and Washington Prime, although we were worried we might face something like that in HIT, was post-filing there was a formation of an equity committee. And from my experience, anytime you negotiate a recovery to shareholders as a so-called gift, you're pretty much setting yourself up for a high probability that an equity committee forms. And you saw that in Washington Prime, and they immediately hired advisors and were heading towards a contested confirmation evaluation fight. They ultimately settled and squeezed out a little bit more value to shareholders. In HIT, what we benefited from, frankly, was that it was a non-traded REIT. There were hundreds of shareholders, but a lot of them were, frankly, mom-and-pop type shareholders. They weren't sophisticated institutions, and they hadn't, they weren't paying attention to, frankly, to the bankruptcy docket, et cetera. And we avoided the formation of an equity.
Real lucky. I mentioned that there were a few bankruptcies. We just talked about a couple in the hospitality space, hotels in particular. Why do you think there are so few traditional restructurings in this space with a bankruptcy and a filing and a process like that? A lot of them, and Jeff, you mentioned this, they were doing recaps and a lot of deals outside. I know you've converted yourselves to distressed M&A group instead of bankruptcy because there just aren't many filings. Why do you think that is, and do you think it's going to change?
Look, I think it's predominantly cap structure related. You look at some of the larger, recaps that happened. They were either one case Watermark, which was another non-traded REIT, but it didn't have any corporate facility, and so you really just had a bunch of mortgages underlying properties. And I would say, courts have generally not wanted to get involved in like a CMBS structure or other where there's very professional and institutionalized rules and institutional investors in terms of rules of how it's supposed to play out. So I think it's really just cap structure related where, in the HIT case, you had this preferred holder across the three debt stacks. But I think it's really, where you have a lot of these private platforms, they really are a bunch of individual sort of mortgages and silos, and you don't have that sort of corporate corpus, which to me is sort of most and best suited for bankruptcy.
Closing thoughts? Promise I'd get us back on schedule.
So the only thing I would say is that, as we're considering where the opportunities are going into 2022 and beyond in the distressed and hotel space, at the end of last year, there was $178 billion of dry powder focused specifically on investing in real estate, distressed and opportunistic hotel deals, not specific to hotel. So there's going to be a lot of capital chasing deals in the coming years. It has to be deployed or they're going to lose it. And so those will cause problems down the road, and in a few years, we'll probably be pretty busy.
I would say two quick things. Thinking of the hotel customer on a segment basis, the consumer, the leisure traveler is driving recovery right now, and there's a lot of disposable income. Now, if that for some reason is eroded, whether by inflation or just people aren't feeling good about the world, or the Omicron variant or some other variant, that really puts a dent in the recovery. And the other thing is, all of you, business people, are you going to the office? If you're not going to the office, that's going to inhibit people coming from another city to visit you and staying in a hotel. And also the food and beverage and related services at hotels that especially downtown hotels rely on. So, there's still a lot of uncertainty in terms of demand, and a lot of question marks for next year.